Before we start talking about firm behavior, I want to take a minute to talk about economic profit because it is different than the way that normal people talk about business profits. So obviously economic profit is total revenue minus total cost, but we have to remember that in economics, we're always taking account of opportunity cost. And what that means is that total cost includes both the explicit costs, the bills, right? The rent, the cost of labor, etc. But it also includes implicit cost, the opportunity cost of those purchases. So when normally you would hear someone talk about whether or not a business is profitable, they're referring to accounting profits. Is the total revenue from that business greater than the bills? Is the business bringing in literally more money than they're paying out? And that is accounting profit, which is total revenue minus bills, minus your explicit costs. But theoretically, when we're talking about total cost, we are including in that also the implicit costs or the opportunity cost of running the business. And this is really important when we start to interpret what it means for economic profit to be positive or negative or zero. Because in some sense, what we have here is economic profit is equal to accounting profit minus your opportunity cost. So what does it mean for economic profit to be positive? When economic profit is positive, it means that your accounting profits are higher than your opportunity cost. So I'll remind you here that opportunity cost means the next best alternative, the value of the next best alternative. So if you were not running this business, what else would you be doing with your time and your resources? And so this means when economic profit is positive, that this business or this industry is earning above average accounting profits, right? Because the opportunity cost is kind of like the accounting profit that you could earn in a different industry. So when economic profit is positive, we say that that this business is earning above average returns. And one way to think about this is really like just the return to capital, like money, right? I'm saying capital here to mean like a monetary investment. Like if I'm going to invest money to open this business, am I going to earn a return that is higher than the opportunity cost? What I could earn on that investment, maybe in the market or in investing in a different industry. So when profit is positive, we will see investments flow into this industry as it's earning returns higher than average than other opportunities in the market. And when profits are negative in this industry, it actually doesn't mean that businesses are losing money. It means that the return in this industry is below what you could earn in other industries. And that zero profit point also doesn't mean that accounting profits are zero. It means that your accounting profits in this industry are equivalent to what you could be earning in other industries. So this is kind of a really important interpretation of economic profit for understanding what we are predicting in long run entry and exit, which we'll get to in a little bit. But here I just want to emphasize that this profit here for us theoretically includes both accounting profits and opportunity costs. In business, sometimes this is referred to as economic value added. So what we're talking about is how much value can the firm add in this industry above average returns?